What if the best business for you is not the one you start? What if it is the company already serving customers, paying employees, and solving real problems, but its owner is ready to move on? Veterans are often told to build from zero. There is another path. Buy the business. But do not confuse buying history with buying safety. In episode 6, we started with one customer problem and the evidence that people will act. An existing business may already contain some of that evidence. It may have customers. It may have employees who know the work. It may have equipment, supplier relationships, licenses, processing, and years of operation history that can make acquisition attractive. Instead of asking whether anybody will buy, you can examine who already buys, how often they return, what it costs to serve them, and whether the company produces enough cash to support its obligation. But an existing business also carries a past. You're not buying only the good parts. You may be buying the weak records, old equipment, customer concentration, cultural problems, legal exposure, deferred repairs, and relationships that belong more to the seller than to the company. When a listing says a business has revenue, equipment, and loyal customers, slow down. Ask what transfers. Does the lease transfer? Do the licenses transfer? Will key employees remain? Are customer contracts assignable? Does the company own its name, website, phone number, data, processes, and intellectual property? Is the equipment owned, leased, financed, maintained, or near replacement? And how much of the company's success depends on the current owner's personality? If every important customer calls the seller's private phone, the company revenue may be less transferable than it appears. If the seller performs skilled work that nobody else can do, you may be buying a job that disappears when that person leaves. If the company has a strong team, documented processes, clear records, diverse customers, and a credible transition plan, you may be looking at something more durable. Financial statements tell a story. They do not always tell it clearly. A seller may explain that certain experiences are personal or will disappear after the sale. Those adjustments are often called add backs. Some may be reasonable. Others may be optimistic. The buyer has to separate what the current owner chooses to spend from the next owner must spend to operate responsibly. You also need to distinguish profit from cash flow. The business may look profitable while customers pay slowly, inventory absorbs cash, equipment needs replacement, or taxes remain due. A seasonal company may appear strong in one month and desperate in another. A growing company may consume cash faster than it earns accounting profit. And a business with one dominant customer may look stable until that customer changes suppliers. This is why you test the records against reality, bank statements, tax returns, customer invoices, payroll, contracts, inventory, maintenance records, accounts receivable, accounts payable. No single document proves the business is healthy. The evidence must fit together. Due diligence can sound like paperwork. It is really a leadership experience. You are identifying risk before accepting responsibility for employees, customers, debt, and the seller's legacy. Financial diligence asks whether the earnings are real, repeatable, and sufficient. Legal diligence examines the ownership, the contracts, the disputes, the permits, intellectual property, employment issues, and obligations and ethics. Operational diligence looks at how work is sold, scheduled, delivered, checked, billed, and supported. Commercial diligence asks why customers buy, why they leave, how competitors behave, and whether the market is changing. Technology and security diligence asks who controls the system, whether data is protected, what subscriptions or license transfer, and where the company is vulnerable. Human diligence asks which employees are essential, whether compensation is realistic, what knowledge lives only in one person, and how people may react to new ownership. You should not perform all this alone. SBA guidance recommends professional help, including an attorney and accountant, depending on the business. You may also need industry, environmental, insurance, cybersecurity, licensing, tax, financing, and valuation expertise. The purchase is not to eliminate every risk. That is impossible. The purchase is to know which risks you are accepting, which can be reduced, and which should end the deal. A business can be fairly valued and still be unaffordable for a particular buyer. The purchase price is only one part of the capital requirement. You may need working capital for payroll, inventory, insurance, repairs, deposits, marketing, professional fees, and the period before the customer cash arrives. The debt payment must fit the company's realistic cash flow after necessary reinvestment and reasonable owner compensation. Financing may combine buyer equity, lender debt, seller financing, or other approved resources. Each layer changes control, risk, return, and what happens if performance falls short. Do not structure a deal that works only if every optimistic assumption comes true. Build room for reality. Even a healthy company can be demanding by a careless handoff. Customers need to understand what will remain reliable. Employees need honest communication on what the new leadership will be like and the new expectations. Suppliers and lenders may need notice or consent. The seller's role must be specific. How long will that person stay? What will be taught? Who introduces the buyer to major customers? What decisions remain with the seller and when do they end? A vague promise that the seller will help as needed is not a transition plan. Respectful succession requires clarity. Before you search for a company, answer 5 questions. What industries and business models do I understand well enough to evaluate? What role am I prepared to perform every day after closing? How much capital can I risk without putting my family in an unacceptable position? Which professionalisms must be on my diligence team? What evidence would make me walk away even after I have invested time and the emotion? The last question matters. Deal excitement can become tunnel vision. Leadership includes the courage to say no. Buying an existing business can give a veteran a faster path to customers, operation, and ownership. It can also transfer problems the buyer did not create and may not be prepared to solve. The answer is not fear. The answer is disciplined investigation. Understand what transfers, test the cash flow, build the right advisory team, price the risk, plan the handoff, and be willing to walk away. In episode 8, we will look at the other side of this transaction. What happens to a town, a team, an entire owner's life work when there is no successor? Acquisition can be more than a path for a buyer. It can be a way to save Main Street. So click that subscribe button down below, hit subscribe to VestVet, and let's see you at the next episode.